Motion second, we approve the minutes from the executive session on January 25th. Any additional discussion? Hearing none, all those in favor?
Aye.
Opposed? Motion carries. Approve the minutes of the meeting of January 25th.
I'll make a motion to approve the minutes of the previous meeting held January 25th, 2022.
I'll second it.
Motion second, we approve the minutes of the meeting held January 25th. Any additional discussion? Hearing none, all those in favor?
Aye.
Opposed? Motion carries. List of claims. Look at the claims.
I'd like to make a motion to approve the list of claims dated February 8th, 2022 as presented by Chris Johnson.
I'll second that.
Motion second, we approve the list of claims dated February 8th. Any additional discussion? Hearing none, all those in favor?
Aye.
Opposed? Motion carries. Purchase orders.
We have two purchase orders in front of you. The first one is to Ferguson. These are breakaway kits for hydrants. These are the pieces that are designed to break if somebody hits a fire hydrant. The cost is $1,220. The other purchase order is to Security Door Incorporated. That is to replace the south door and it's a thickener tank door repairs at the plant. This was in our capital plan for the year. So it'll be part of our improvements budget. And that's for $11,179.
Out of curiosity, how do the breakaway kits work?
I was going to ask that too.
Basically, the cast iron part that's on the outside is a coupling, and it has parts that are designed to break, so then when a vehicle hits it, it doesn't break the actual casting of the fire hydrant. These pieces break off. They're cut thinner so that they snap early. And then there's also a coupling in the middle for the shaft that runs inside the fire hydrant, and it has a tapered portion that's designed to snap off rather than have the shaft bend or break.
So are all our hydrants equipped with that?
All of our newer hydrants are. We do have some older fire hydrants that do not have that because they were built long before those existed. So if somebody hits some of those, we end up having to replace the fire hydrant itself.
Can't retrofit it,
No, those older style ones are cast.
Yeah.
A lot of those are cast from down in the ground all the way up through the hydrant barrel itself. The newer fire hydrants came in two pieces, where the lower piece that's in the ground is one piece, and then the barrel part that you see above ground is another piece, and so those are able to have those breakaway flanges on them.
All right, thank you.
So it's not like the movies, they're not going to go gushing up if you run into one with your car?
No,
Unless it's the old ones.
No, that happens in California because they use what's called a wet barrel hydrant.
Oh.
Their water, because they don't have the cold temperatures, their hydrants are always full of water. Ours are actually dry.
Oh, okay. Oh, good. Good to know.
Okay, we got a list of purchase orders in front of us. Anybody like to make a motion?
Motion to accept the list of purchase orders dated 2/8/2022.
I'll second it.
Motion second that we approve the purchase orders dated February 8th. Any additional discussion? Hearing none, all those in favor?
Aye.
Opposed? Motion carries. Bad debt list.
I make a motion to approve the bad debt list dated February 8th, 2022 for bookkeeping purposes only.
I'll second that.
Motion second that we approve the bad debt list dated February 8th for bookkeeping purposes only. Any additional discussion? Hearing none, all those in favor?
Aye.
Opposed? Motion carries. All right, Brian, you're up.
Very good. Well, thank you for having me this evening. Fortunately, I have good news to share. We had a pretty good year last year, 2021. We had solid economic growth. And that led to, in addition to lower interest rates, to really good performance on risk-oriented assets such as the stocks in your portfolio. Page 3 of the packet here in front of you, you can see that the performance for the pension since the inception of the account is almost 7.5% versus the benchmark return of about 5.9%. The balance of the portfolio finished the year at $19,236,000. That was growth of nearly $3 million since the previous year of 2020. You don't have that figure on there.
Right.
You have the 19 figure. I just realized that this afternoon. The 2020 year-ending figure was $16,426,000. So really good growth in the portfolio year over year. The asset allocation finished the year at just under 70% stock, about 27% in fixed income, and the remainder in money markets. Again, that's at the high end of the range of our equity allocation for the portfolio. And certainly with strong economic growth, we're really in the beginning of this next business cycle. And although we've got some things that have popped up, like some inflation that we haven't seen in a long time, risk assets still look like they are set to outperform non-risk or risk-averse assets such as fixed income, bonds, cash, and so on. So we'll probably maintain a pretty hefty overweight to risk-oriented assets throughout the next year. And as you flip forward to, let's see, page 4 here, we've got an investment strategy update for you. Again, talking about what we're expecting for 22. You can see there in the U.S., we're looking for GDP growth of about 4%. That's still really strong when you consider that prior to the last recession, the pandemic-led recession, we were averaging about 2 to 2.5% economic growth. Not just here in the U.S., but worldwide. And so when you look at the fact that the U.S. and most developed nations are in the 3 to 4% growth range still, that exceeds the long-term growth channel that we had seen prior to the pandemic. So there's still a lot of fundamental strength in our economy and in most global economies. So let's talk about the one bad thing in the room, right? And that's inflation. How does that impact our portfolio? What are we doing about that to protect the portfolio? So anytime you see inflation expectations change, and they certainly have over the past 6 months in particular, the first thing you have is the Federal Reserve's response to that, to try to adjust monetary policy to make sure that they're doing the right thing for the nation from a monetary perspective. And so what you see is the Fed was willing to allow inflation to exceed their targets of around 2 to 2.5% because they wanted to make sure that our economy was in really good footing. And they didn't want to risk coming out of this pandemic and then flipping right back into a recession because they were too quick to take monetary accommodation out, okay? And so now that they feel like the economy is strong enough to stand on its own, hopefully we're seeing the teeth of this pandemic really, weaken. And hopefully we will see the labor force and so many other disruptions that we're experiencing start to wane over the next 12 to 18 months. It's certainly been a long sled, hasn't it? Mm-hmm. So, now they've announced that they're going to be tapering their bond purchases, so that's going to take some of that monetary accommodation away from the markets, some of that fuel. They're going to be raising interest rates, short-term interest rates. Likely we'll see somewhere between 0.5% and a full percent increase to short-term interest rates this year. And that's a good thing. That's That's a normal thing that you experience. When we had the pandemic, when it first started, and the financial markets were in a state of shock, they provided accommodation by taking rates from about 1% down to 0, okay? So this is just getting back towards more of a normalized atmosphere for interest rates. So assuming that our estimates are correct and that we see the Federal Reserve able to handle this inflation issue, assuming that we don't see an economic recession within the next 12 months, and we think that the economy is strong enough to withstand that, then it stands to reason that when you look at performance of assets over the years, equities or stocks is the right place to be for the portfolio. So not just any equity portfolio, but a portfolio of really high quality companies that are able to absorb some of those costs, okay, those inflated costs, because they're all suffering from supply constraints, right, logistical constraints. So they're able to absorb those, and then they're able to pass a reasonable amount of those costs onto their client in product or service price increases. And so those companies are performing very, very well right now. You know, the other thing that we do or have done in your bond portfolio, at some point we were expecting higher interest rates, right? You know, we're in the, I don't even know how many years now we've been in this low interest rate environment. It feels like 2 decades. So at some point rates were going to rise. And so we had been fairly conservative in the way that we managed the fixed income within your portfolio. It was very short in nature. Our benchmark is about, average is about a 4-year average maturity. The fund is around a 3-year average maturity. That certainly helped as we saw changes in the inflation expectations, okay? And we'll see that in the performance in just a minute. So let's flip forward to page 8 in your packet, and it has the account profile at the top. We've already talked about your asset allocation, but let's look at a couple of other things, digging in a little bit further. When you look down at the bottom right-hand corner and you look at each of your asset classes, look at the yield on your equities, about 1.3%. That's another sign that, with lower interest rates, the yield on equities has pushed lower as we've had very good performance. So what we're doing inside the portfolio is, since large cap stocks look pretty fairly valued, we're actually making a shift towards small and mid cap companies which have a better growth rate long term, have a better valuation than large cap stocks currently, and have about the same yield as large cap stocks. So it stands to reason that throughout the rest of this economic recovery, small and mid cap stocks should, at least are set to perform very favorably versus their large cap competitors. The other thing that we've noticed is international stocks also have a really nice valuation compared to our U.S. stocks. They haven't performed as well over the past few years. We've been underweight in the portfolio up until this point because we preferred the strength of U.S. stocks. However, that's really shifting. We're starting to see better performance overseas, and so we're starting to move that allocation of international stocks up. So those two things will help our equity yield a little bit. You can see the fixed income yield of the portfolio about 3%. That compares to the a 10-year Treasury, which has recently come up, but still only about 1.8%. So your fixed income portfolio is still about double that. Let's talk about cash equivalents or short-term interest rates. You can see 0.03, okay? Virtually no yield there in your cash money markets. As we start to see the Fed increase rates this year, you'll start to see that rise. And so with each quarter point rise, we'll get a little bit of relief in our cash holdings there. Page 9, the fixed income portfolio overview. Again, I talked about the average duration. The exact number is about 2.8 years. So again, we've kept that a little lower, but as we have bonds that mature and roll off, and as we have cash to reinvest from interest and dividends, we'll be extending that maturity ladder out into that 5 to 10 year range. Probably not out as far as 10 years, because we still believe that we should see rising interest rates over the next few years, but probably in that 4 to 7 year range is where we're going to be and pick up some additional yield for the portfolio. Looking at page 11, the individual equity holdings. You know, a couple of things that we did last year when we rebalanced the portfolio, even though we didn't make significant changes to the total equity position, we made some changes within the portfolio itself. And if you look in the very middle of the portfolio at the bottom, and you look at that information technology, the blue bar is the pensions portfolio weighting. It's a little over 20%. The orange bar is the S&P 500, or the benchmark, and it's over 28%. So at Harbor, we have a policy constraint. We won't allow ourselves to invest more than 25% of the portfolio in the equity portfolio in any one sector. It's interesting that because of the strength of technology, and let's face it, technology is really what helped us get through the pandemic, particularly in early days when we were all working remotely, working from home. You know, a great majority of the country still is working remotely, albeit probably at a warmer and more desirable location now. You know, technology is really important. However, it's a big risk if you continue to invest at that level to 28 to 30% of the portfolio. So last year we took some profits out of the portfolio, recognizing, you know, how stretched the valuations were in technology. And what we've seen this year in the pullback, again, a normal pullback that we've experienced in January, we've seen those high PE stocks, those technology companies, we've seen those react the worst, okay? We've seen those get beaten up a little bit more than average. They're still great companies, still great industry. Love the fundamentals and growth there, but we have to do the right thing for our clients' portfolios and take risk out of the portfolios where we should. Okay? So again, taking some profits there, increasing our weightings in international and small and mid cap at the far right side. And finally, let's take a look at performance. So if you'll flip to page 16. Just some subtle things here. If you look at the fiscal year-to-date period, which is in the middle at the bottom of the page, and you'll see each of your asset classes represented. And the first thing that your eye is drawn to is the 36% return from your U.S. equities. You know, our companies, with our emphasis on quality, with their ability to maintain their superior economic advantage against their peers, is really paying off. You know, when we look at the benchmark of about 29%, you know, we got some outperformance from our stocks because the market really is paying more for higher quality these days. The other thing that's really fascinating is when you look at the line just above that, the taxable bonds, where the majority of your fixed income is positioned, about 25% of the portfolio. The benchmark return was a minus 1% for that period, for 2021. So what it's saying is most taxable bonds that are intermediate term in nature actually declined last year even after they paid their interest. What you see is your portfolio was up about 1% during that same time. So again, some of the steps that we took earlier last year to make sure we were positioned both in stocks and in bonds where we wanted to be really helped the portfolio. Overall, a 21.3% return was really strong. Going forward, just briefly, our outlook for 2022, we've already seen some of the volatility that we thought we would see, particularly with low interest rates. And, there are an awful lot of investors that are, have more funds allocated to U.S. equities than they have in the past, just because the opportunities in fixed income aren't that good. With interest rates at 1 to 2%, it just wasn't that attractive. So we know there's going to be more volatility, particularly when we get new shocks such as changes in inflation, changes in our labor force, the supply-demand constraints that we're seeing, logistics issues. These top, line news items are going to drive some volatility in these markets. We're expecting much more modest stock returns this year, probably in the neighborhood of 4 to 6%. So again, a far cry from the 20% that we saw in the prior year. But still, we feel that 4 to 6% is more attractive than what we're expecting from fixed income, which is probably more in the area of 2 to 3. Okay? Now, having the fact that we saw negative interest rates in most bond portfolios last year, 2 to 3% actually looks pretty attractive. We're still likely to stay overweight in risk in the portfolio, but manage the risk as appropriately as we can, making sure to take risk out of the portfolio when it doesn't make sense for the portfolio. If we see good economic growth continue this year, we should have another good year of returns in the portfolio. Okay? Any questions that you all might have?
You mentioned you expect overseas markets to perform better. Is there a certain geographical area?
It's a great question. It's so difficult to predict, is Germany going to perform well this year, or is it Japan? And so what we traditionally do is we like to take a basket of developed nations. We are staying away from emerging market nations, okay? So China, India, number one, they've had more difficulty with COVID. They just don't have the high vaccination rate, even as high as what we have here or what other developed countries like Europe would have, okay? And they're really struggling with their growth rate. Even though, say, China is growing at around 6%, when you look at economic indicators, they're barely in the growth range. 6% for them is like 1.5% for us. It's hit and miss between growth and contraction. So we're staying away from emerging markets at this point. Within the developed nations, it's actually interesting. Japan, who has been a laggard all these years because of their debt issues, significant debt issues there. We're actually seeing upwards of about 3% economic growth for Japan this coming year. So we're going to stay pretty diverse with a basket of securities. Some of the work that my team has been doing, when you look at long-term rates of return from asset classes, okay? If you look at the differential between returns in the U.S. and overseas, about 40% of returns are determined by what the current valuation is, so the PE ratio, right, the price to earnings. But when you move out to 10 years, it explains about 80% of returns. Right now, the developed international markets are trading at about a 27% discount to the U.S. markets. That's some of the lowest, some of the largest discount we've seen in history. And so at some point, we feel like those markets are going to catch up. It's difficult because in the short run, valuations can persist. And in this case, we've seen the U.S. continue to perform really well. And so when you see these long-term indicators, at some point, those make a big difference. So hopefully we'll see that shift start to take place this year. I do want to tell you, though, a lot of financial advisors would argue that you should have a third or half of your equity positioning in international equities. Harbor Trust just doesn't believe in that, okay? Most of our clients Their liabilities are here in the U.S. in U.S. dollars, and it makes more sense for us to have an own country bias. So you probably won't see our international exposure exceed 10 to 12% of the stock portfolio. Okay? It's just we prefer, even though the volatility is similar between international and the U.S., we prefer longer term to have a significant overweight in U.S. assets.
Thank you.
You bet. Any other questions?
Brian? Well, keep it up.
Thank you very much for
Thank
having me
you.
this evening.
Thanks a lot, Brian.
That's good news.
Yeah, very good.
Good news.
Okay, I guess I did warm this up a little bit.
Yeah. Yeah.
Approval of the pension plan administrative services agreement with One America, McCready and King.
Yes, so you have a copy in your folders. In 2016 was the last time that McCready raised the prices to do the things they do for us when it comes to processing our retirement retirees, and also providing us our reports. And so they're looking for a slight increase. A lot of things that we do on a regular basis, for example, the benefit calculations, when an employee is retiring, that price is almost the same as what it is today. It's not much of an increase. That's one of the more common uses that we have with them. So really, these aren't huge increases over what we already were paying for them to do the actuarial activities and preparing the pension payouts so that we can send, and then Harbor Trust actually sends the checks to the retirees. But McCready Keene gets all that paperwork figured out, what they're supposed to get and all that stuff.
So overall, it's a 1.9% increase, annual increase,
Yeah,
overall.
yeah. Well, that's 1.9% per year since the last increase, so yeah.
Yeah, gotcha.
That's not too bad at all.
How long have we been with them?
A long time.
That's what I thought.
I'd have to dig back in the file cabinet to see how far back it goes. But McCready Keene, well,
16 years.
yeah, and McCready Keene got merged with One America, so that's why it's now One America McCready Keene.
Anybody have questions on
Well,
the,
it does say here, effective January 1, 2011. Has it been since then? Right? By the second amendment, the service agreement effective 2011, January 1, 2011?
yeah, it's the minutes, right?
Mm-hmm, the second amendment, mm-hmm.
It was prior to that.
Yeah, that's still a
Yeah.
while. So even before that, if that's the second amendment. Okay.
I can make a motion to approve the pension plan administrative service agreement with One America, McCready and Keene as presented.
I second it.
There's a motion second, we approve the pension plan administrative services agreement with One America and McCready and King. Any additional discussion? Hearing none, all those in favor?
Aye.
Opposed? Motion carried. You review the actuarial report.
Yes, in your packet you have an actuarial report for the calendar year ending December 31st, 2021. And then also the Governmental Accounting Standards Board report statement numbers 67 and 68. These are annual reports that are produced by McCready King for us. In reviewing this one of the things that McCready team looks at is how is the pension funded based on the employees we have today and the employees that are already retired and the people that no longer work for us but will still get a pension at some point. And then they look at our financial position with the work that our trustees at Harbor Trust are doing with that portfolio, which is why I had the portfolio presented first. So the most important piece on this, basically on this cover letter, they hit it. They always produce a maximum contribution and a minimum contribution recommendation. For us, because of the position of our pension plan right now, we don't have to put any money into it. They always provide that as an option. And if you go to page, if you go to page 7, I'll explain why we haven't been putting money into the pension plan. As you'll see in the first column, January 1, 2021 valuation, if you go down to what's called the ENAL, EAN-NAL funded percentage, as of January 1, 2021, we were funded 143%. In January 1st of 2022, we were funded 155.6%. So, as you may know, a good corporate America likes to be around 80%, 80 to 85%. 100% is considered excellent. We're at 155.6%. So, and these numbers have been adjusted. We did have the salary increases with our employees, and those were taken into account for this valuation. So right now, basically their recommendation is we could decide if we want to put any money into it or if we don't. And we haven't put any money into it in years because it's been performing so well.
On the first page, it says, please note that a contribution is being recommended for 2022. It reflects the cost and benefit accruals.
Yeah, they've always made that recommendation.
Okay. Okay.
If now there were, if we had a year like what we had, 2009, would you say?
Yes.
2009. We might have had to consider something like that because there might have been enough loss in the portfolio that it could have hindered the position of the pension plan. But as of right now, with the pension plan being as well funded as it is, it doesn't make a lot of sense for us to put money into it. We do still pay the fees because you can actually roll the fees in and have them actually taken from the pension plan. We do pay our fees. We do pay that through our claims process. So we're not putting money into the plan, but we are not allowing the cost of the plan to impact the plan. I think your costs do come out of it. That's standard practice with the trust. But with McCready team,
about how much is that, Chris?
What you guys charge a year?
I don't recall what it is. The larger the fund grows, obviously, the pro rata basis of the fees come down. But I can certainly get that for the board, though.
Yeah, I don't think
it's in here.
It's not in here.
It's not.
One America McCready, do we have an idea of that?
What we pay them annually? Yeah. I'm not sure, no. I'd have to check
By the
that.
next meeting, can we get that?
Yeah, I can get that.
Just out of curiosity.
And of course, our spend per year will fluctuate based on the number of employees that leave our employment. Because obviously, everyone that leaves, we have to do their pension paperwork. So this, just wanted to provide this information to you, for your review. If there's any other questions, or if you desire to have, we could have Stan Brown from the McCready team. I think he would have to do his presentation by Zoom. I don't believe they are going places yet. They're still working from home, from what I understand. So if that would be the board's desire, I could have that happen.
Anybody think that's necessary?
I don't. No. But thank you.
There was no action that was needed on that.
Yeah. All right. Old business?
Under old business, I've been in communication with a couple of the property owners on Twilight Drive. They have mailed their checks, so we're expecting them this week. So once those checks arrive, then I will get an engineering quote put together to get that project going, and I'll have that quote in as a PO on our next board meeting. Hopefully I have those checks in time for that. As an update on the main extension in the annexation area in US 20, Haas and Associates is still working on the engineering report for that, but I think we're getting pretty close to completing that engineering. That was a preliminary engineering report in the event that we were looking to, if we had to consider bonds or SRF money, we needed to make sure we had something more than my estimate. I am still awaiting a response from the union about the topic from the executive session that we discussed.
Okay.
At the AWWA section meeting is April 11th through 14th. So far, Davis has indicated a yes, and Ken is a probable. If anybody else is interested, please let me know, because I plan to get the hotel rooms immediately, because those go quick. You don't have to come for the entire time if you didn't want to. Tuesdays and Wednesdays are the days with the most classes in them. So if somebody's just interested in coming down for a couple of days, that can be done as well. Just let me know. I'll get the hotel rooms. Thursday. So let me know by Thursday.
Okay.
We are going to be making our final payment on our 2014 bonds, which is great. It doesn't mean that we'll have a ton more money to spend on other things, because our 2015 bonds increase in cost per year to offset that. So there's a little bit of savings, but not that much. And that's all I have for the old business.
Anybody else have anything under old business? New business?
Under new business, concerning the AWWA meeting, our first meeting in April was supposed to be on April 12th, Tuesday, April 12th. I was going to request if we could move that meeting up a week to April 5th, the Tuesday at 7 p.m.
Anybody have a problem with that?
I think you'll send out notice, right?
Yeah.
I'm fine. I'm fine.
I'm good.
Okay.
So we'll move that to April 5th, and that'll be 2 weeks. That'll be 2 weeks after our last meeting in March.
Okay.
Because that was 5.
Yeah.
Okay.
Okay.
Sounds good.
And that's all I had under new business.
Anybody else have any other new business? Public comment.
I have a public comment. Dalia Gigas, Michigan City Common Council. Very interesting meeting, and I really like the investment perspective, so that was very interesting.
Thank you, Delia.
Okay, anybody else from the public? Dan? All right, director's comments. Nope.
I want to thank Dan for filming us for this time.
Yes.
Bringing it up and
Yes.
with us, and we'll miss you.
Namaste.
And Ryan, again, thank you for the report.
Thank you.
Great report.
Great report.
Great. Good news.
Always good.
Yes.
I'll make a motion to adjourn the February 8th, 2022 meeting of Waterford. Second.
Motion second to adjourn.
Bye.
Right. Sorry.
Adjourn.